Good morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities, and welcome to Monday Minutes. Extreme measures out of the Fed this morning. Unlimited quantitative easing, programs dedicated toward protecting the shorter end of the muni market, programs intended to protect the investment-grade credit market, including ETFs. We've talked a lot about the liquidity in the marketplace, and health is clearly first and foremost here, but we've moved from a health crisis into an economic crisis and now a liquidity crisis. And they're all important at this point. Health, obviously, first and foremost, but we can't ignore these other facets of what's happening before our eyes right now. And we've talked about the drain in dollars, the move in the dollar last week. At one point, we had asset classes across the board declining together, which is typical of a pocket of time where people are looking to raise cash. We saw the Fed increase their international swap lines to include some emerging market countries. When you look at it in its most simplistic sense, at every level, whether it's on the corporate level, whether it's on the sovereign level, state and local municipalities, whether it's individuals whose lives are being impacted from an employment perspective, whether it's small businesses. With the economy shutting down in this dramatic of a fashion, the need for dollars right now is critical. And those dollars have to come from somewhere. And when you look at asset classes across the board, you look at some of the dislocations, a lot of what the Fed is trying to do right now is stabilize markets, provide the necessary liquidity into pockets of the market which are exhibiting extreme stress, trying to get dollars into the hands of small businesses, support the asset-backed securities markets, the CP market, the money market funds. This is an all-out effort across the board. All eyes right now are on DC. And we look at the Secretary of Treasury. He's using the Exchange Stabilization Fund right now to put money into some of the programs that the Fed is rolling out there. Part of the contention with the bill right now is over an increase in those funds with the intent to take some of these programs, obviously increase the size in conjunction with what the Fed has done short term from their balance sheet perspective, which they've indicated now is clearly unlimited. These are extreme times right now. They're not times really to question, to judge. These are times to act. And right now we need action out of Washington. So when you look at the market going forward here, you look at the Fed, we still think the Fed is going to continue to act more aggressively on a short-term basis. There have been some dislocations in the U.S. Treasury market. And when you look at it, at a time right now where the fiscal programs that will be rolled out, and we don't even consider these programs to be stimulus, this is more liquidity than anything else, getting dollars into the hands of the individuals and the small businesses that really need the money. When you look at this on a short-term basis, the financing needs of the Treasury Department, and Secretary Mnuchin has said this, are going to increase fairly dramatically on a short-term basis. So what we see right now, a lot more Treasuries will be hitting the market, and the Fed will be increasing their balance sheet dramatically on a short-term basis going forward. We hope everyone is safe and secure. Clients, we are here for you. Please feel free to reach out with any questions. We'll be sending out updates daily.